Hi there, I'm Edward Kalstian, founder of EKH Capital, and welcome back to the channel. Today we're diving into a topic that every investor thinks they understand, but most actually don't. When people hear the word risk, they often imagine losing money or watching their portfolio drop overnight. But here's the truth, that's not the full story. Today we'll talk about what risk really is, the kinds of risk most people ignore, and how you can actually use risk to your advantage. But here's the thing, volatility isn't always bad. In fact, volatility creates opportunity. If Amazon drops 20% in a month, and you know the business is solid, is that risk or is it a discount? Legendary investor Warren Buffett says it best, risk comes from not knowing what you're doing. In other words, true risk isn't just price movement, it's the chance of permanent capital loss. Buying a company that's slowly dying, that's risky. Buying a great company that's temporarily out of favor, that might be smart. Let's go deeper. Here are 3 types of risk most investors overlook. Markets are emotional, and so are we. The risk isn't always the market, it's our reaction to it. Panic selling during a crash, buying into hype, fear of missing out, holding onto a loser out of pride. These are the behavioral landmines that hurt returns more than anything. Leaving cash under your mattress, it loses value every year. Even savings accounts and bonds can be risky over the long term if they don't beat inflation. One is technically not losing money, but purchasing power is slowly evaporating. Putting too much money in one stock, one industry, or even one country. It might work for a while, until it doesn't. Diversification isn't sexy, but it's an insurance policy against the unexpected. So how does one manage risk without playing it too safe? Here are 4 core strategies I personally use and recommend to any long-term investor. Don't just buy tickers, buy businesses. Understand how they make money, what could hurt them, and why you believe they'll grow. The more you know, the more confidence you'll have when prices drop. Buy with a buffer. If you believe a stock is worth $100, aim to buy it at 70. That cushion protects you if you're wrong. Time is the greatest risk reducer. Over 1 or even a few years, stocks are unpredictable. Over 10 or 20 years, history shows that patient, disciplined investors win. Volatility fades with time. An investor doesn't necessarily need 100 stocks, but it is worth avoiding overexposure. Consider spreading bets across sectors and regions, so one bad apple doesn't ruin the bunch. So what's the truth most investors ignore? Risk isn't about short-term price swings. It's about making uninformed decisions. The better your research, the better your mindset, the lower your real risk. One tool that's helped me level up my research is FinChat. I've been using it for years, and if you want to dive deeper into company fundamentals, I've got a 15% discount code in the description. It's a great way to take your investing to the next level. If you found this helpful, give it a thumbs up and subscribe for more investing insights. And let me know in the comments, what do you think is the biggest risk in today's markets? Thank you for watching, and I'll see you in the next one.